In this episode, I'll be talking about a simple process of using weekly profiles. What is a weekly profile, and how does it look on an actual chart? I'll show you how you can use it to identify your daily as well as weekly bias. So let's quickly get into it. With that being said, we can start by answering the question of what a weekly profile actually is, and how it translates onto a chart. The foundation of this concept comes from understanding how a weekly candle forms. Specifically, we're looking at two main structures. On one side, we have a bullish weekly candle, which follows an open, low, high, close sequence. On the other side, we have a bearish weekly candle, which follows an open, high, low, close sequence. Now, when you break that single weekly candle down into a daily chart, those 5 daily candles that make up the week are what we refer to as the weekly profile. This is where things start to become much more useful, because instead of just looking at one candle, we can now see how price actually develops throughout the week. By understanding how this weekly candle prints across the daily time frame, we can start to build a much clearer and more efficient daily bias. And just as a quick note, while there are more variations of weekly profiles that exist, I simplify everything down into 3 main profiles that I consider high probability. The first one is what we call the classic expansion week. In a bullish classic expansion week, price will form the low of the week on either Monday or Tuesday. This usually happens at a higher time frame discount, PD array, something like a 4-hour level or above. From that point, price begins to expand to the upside through Wednesday and Thursday, delivering a clear directional move into a higher time frame objective. This creates the structure of open, low, high, close on the weekly candle. Now, if we flip that idea for a bearish scenario, we have a bearish classic expansion week. In this case, price will form the high of the week on either Monday or Tuesday, typically at a premium PD array on a higher time frame. From there, price expands to the downside through Wednesday and Thursday, moving into its objective. This creates the open, high, low, close structure on the weekly candle. Now, from the point of that early week reversal, this profile gives us a very clear bias for Tuesday, Wednesday, and Thursday. We are essentially trading in the direction of that expansion. But when it comes to Friday, the approach changes. Using the understanding of the TGIF concept, we are not looking for continuation of that expansion. Instead, we anticipate a retracement back into the weekly range rather than a further push in the same direction. So once you understand how this weekly profile forms and how the expansion develops from the early week reversal, you can start to align your daily bias much more clearly and avoid trading against the overall weekly narrative. The next profile is the midweek reversal. And this is when Wednesday becomes the key turning point for the week and price expands away from that point for the remainder of the week. So starting with the bullish example, the weekly candle still forms an open, low, high, close structure, but the main difference here is where the reversal happens. Instead of forming the low on Monday or Tuesday, the real reversal comes in on Wednesday, and from that point we anticipate price to continue pushing higher into the close of the week, ideally closing near or at the high. Now, if we break this down on a daily chart, Monday and Tuesday are not where the move begins. Instead, those days can either be relatively consolidated around the weekly open, or they can offer small moves away from the weekly draw, often forming what we call a Judas swing. Then on Wednesday, price makes the real move. It trades down into a higher time frame discount PD array, something like a 4-hour level or above, and from that point it reverses and begins expanding to the upside into the weekly objective. Now, if we flip this for the bearish scenario, it's the same idea but in the opposite direction. The weekly candle forms an open, high, low, close structure, and we anticipate that price will close near or at the low of the week. On the daily chart, Monday and Tuesday will either show consolidation or small bullish moves away from the weekly open, again forming that Judas swing behavior. Then on Wednesday, Price trades up into a higher time frame premium PD array, and from there, it reverses and expands to the downside into the weekly objective. Now, the key difference with the midweek reversal profile compared to the expansion week is in how we treat the rest of the week. With this profile, once the reversal happens on Wednesday, we now have a clear bias not just for Thursday but also for Friday. We are anticipating continuation of the move away from that reversal point, meaning we are looking for expansion through both Thursday and Friday in the direction of that move. The third and final weekly profile is the consolidation reversal, and this is when price spends the majority of the week consolidating before reversing on Thursday and expanding in the opposite direction through Friday. So, starting with the bullish example, the weekly candle still forms an open, low, high, close structure. And just like the midweek reversal, we are anticipating that the closing price will be near or at the high of the week. Now, if we break this down on the daily chart, Monday through Wednesday are not directional. Instead, price is consolidating around the weekly opening price, forming an internal range without any real expansion. Then on Thursday, this is where the key move happens. Price will manipulate the external low of that consolidated range, taking liquidity below those lows, and then from that point, it will reverse and expand to the upside through Friday into the weekly objective. Now, if we flip this for the bearish example, it's the exact same concept in reverse. The weekly candle forms an open, high, low, close structure, and we anticipate the close to be near or at the low of the week. Looking at the daily chart again, Monday through Wednesday are relatively consolidated near the weekly open, forming an internal range. Then on Thursday, price manipulates the external high of that range, taking liquidity above it, and from there it reverses and expands to the downside through Friday into the weekly objective. Now, the key characteristic of this profile is that it gives a very clear bias specifically for Friday. Since the expansion begins on Thursday, Friday is where we expect continuation of that move, and the main target is typically the opposing side of that consolidated range. So once you understand all three of these weekly profiles and how they form, you can start to anticipate which days are likely to offer expansion, which days are likely to consolidate, and where your high probability opportunities actually lie throughout the week. And with that understanding in place, you can now move into a structured protocol that you can follow each week to apply this in a live market environment. So that is the complete breakdown of the three weekly profiles and how they translate into real market behavior. Once you understand how each profile forms and which day acts as the point of reversal, you'll start to see that the market follows a very structured delivery. It's not random, it's just a matter of recognizing which profile is in play for that specific week. The key is not to force a bias early, but to let the week develop and then align yourself with the profile that is actually forming. That's what gives you clarity on which days to be aggressive, which days to be patient, and which days to expect expansion. If you stay consistent with this and combine it with your higher time frame levels, liquidity, and entry models, you'll start to build a much stronger narrative behind every trade you take. If you found this helpful, make sure to like and subscribe, and I'll see you in the next one.